If you own Costco for its dividend, and millions of retirement investors do, the math you're about to see explains why Wall Street's consensus is dangerously out of touch with the labor reality crushing margin sustainability. Let me start with the headline number. Costco spent approximately $8 billion annually on wage costs as of their most recent fiscal year. For context, that's not just a line item, it's roughly 34-40% of their operating profit. To put this in perspective, in fiscal year 2022, Costco reported total operating income of approximately $21 billion. Labor costs consuming nearly 40% of that is a fundamentally different story than the rosy guidance management provides during earnings calls. But here's what makes this a dividend crisis waiting to happen. The labor cost trajectory isn't stabilizing, it's accelerating. According to the Bureau of Labor Statistics, BLS, wage growth in the retail and food service sectors, where Costco operates, has been running 4-6% annually over the past 18 months. That's significantly above historical averages of 2-3%. Meanwhile, Costco's pricing power, their ability to raise membership fees and product prices without losing customers, has limits. Their membership fee increases happen on a predictable cycle, typically every 5-6 years, and their gross margin on product sales hovers around just 11%. Compare that to e-commerce competitors like Amazon, who operate at similar or lower margins but have vastly more automation. Let me walk you through the specific SEC filing line item that reveals this vulnerability. If you pull Costco's 10-K filing, their annual report, go to Item 1A, Risk Factors, and then cross-reference this with the income statement in Item 8. You'll find Selling, General, and Administrative Expenses, SG&A, listed at approximately $24-26 billion annually. Buried within SG&A, but also separately disclosed in some filings, is the labor cost breakdown. When you extract the wage and benefit components, you're looking at that $8 billion figure I mentioned. Now here's the critical insight. Costco's revenue grew roughly 8-10% last year, but labor costs grew faster, closer to 12-14% when you account for headcount expansion and wage inflation combined. This is unsustainable arithmetic. Eventually, a line that grows faster than the top line will consume an ever-increasing percentage of profits. Let me give you a specific example of how this plays out. In early 2024, Costco announced wage increases for hourly employees in certain regions. While management framed this as strategic investment, the reality is it was largely reactive, a response to both tight labor markets and competitor pressure from Amazon, who offers $15 plus starting wages, and Target, who committed to $15 minimum wage in 2020. The wage increase, which came across roughly as 5-7% for existing employees in some locations, hit hundreds of thousands of workers. The aggregate cost, conservative estimates suggest this single action added $300-500 million in annual run rate expenses. That's not one time. That's permanent structural cost inflation that impacts every future earnings calculation. Now let's talk about the dividend sustainability math, because this is where your income is actually at risk. Costco's current dividend payout ratio sits around 35-40% of net income. On the surface, that seems conservative. There's room, right? Not quite. Here's why the analysis Wall Street is missing matters so much. Costco's business model is uniquely dependent on member loyalty. The reason they can operate at such thin margins, remember, that 11% gross margin on products, is because membership fees subsidize operations. Annual membership revenue is nearly 50% of operating profit. This high-margin business segment allows them to be hyper-competitive on product pricing, which drives traffic, which drives ancillary spending. But if wage inflation makes that product business unviable, if the unit economics of warehouses start deteriorating because labor costs squeeze margins to 8-9%, management faces a choice. Raise prices significantly, which risks traffic and membership renewal, or cut the dividend to preserve cash flow and reinvestment capability. Payout ratio threshold where dividend growth stops cold is roughly 45-50% of net income. And here's the scenario. If operating profit growth stalls because of labor cost absorption, something entirely plausible if revenue growth normalizes to 5-6% while labor grows 8-10%, net income growth will decelerate quickly. At a 40% payout ratio, if net income barely grows, your dividend barely grows. For retirement investors living on that income stream, stagnant dividend growth in an inflationary environment equals real purchasing power loss. Let me show you the specific dollar impact if management is forced into a freeze. Costco currently pays roughly $2.10 annually in dividends per share. This varies, but it's in this ballpark. If they announce a 2-year dividend freeze, which is entirely plausible if operating margins compress from their current 5.7% to 5.2%, that represents a permanent loss of roughly $10-15 in annual dividend income per share you own. For a retiree who holds 1,000 shares, a reasonable position for dividend income in a portfolio, that's $100-150 in annual income loss. Multiply that across millions of Costco dividend shareholders, and you're looking at a meaningful reduction in retirement income for an entire cohort of investors. Here's the earnings signal that will force dividend repositioning before Q1 tax loss harvesting season. Watch for these specific metrics in quarterly earnings. First, SG and as a percentage of revenue. If this number starts creeping above 7%, that's the canary in the coal mine. It signals that labor cost growth is outpacing productivity gains and pricing actions. Second, warehouse-level operating margins. Costco discloses this in their 10K. If warehouse-specific margins, revenue minus direct costs, including labor, compress by 20-30 basis points quarter over quarter, that's a red flag that wage inflation is hitting the core business harder than anticipated. Third, pay attention to management commentary around labor inflation, or wage pressures in earnings calls. When management starts using cautious language, moving from "we're managing labor costs well" to "labor inflation remains a headwind," they're signaling internally that the situation is deteriorating faster than their public guidance acknowledges. Historically, Costco has been excellent at managing these issues. Their productivity improvements, technology investments in warehouse automation, and pricing discipline have allowed them to navigate cost inflation better than most retailers. But the current wage inflation environment is different. It's broad-based, not isolated to one region or category. It's structural, not cyclical, and it's driven by fundamental shifts in labor market tightness that show few signs of reversing in the near term. For dividend investors, this isn't an argument to sell Costco immediately. It's an argument to stress test your income assumptions. If you're modeling 3-5% annual dividend growth from Costco over the next 3 years, you should seriously consider that base case is too optimistic. A more conservative model, one accounting for labor cost absorption and margin compression, might suggest 1-2% dividend growth, or even a freeze. The specific window to reposition is now, before Q1 2025 tax loss harvesting season, when many institutional investors will begin rotating out of dividend stocks facing margin pressure. If Costco's next earnings announcement, typically Q4 in the February-March timeframe, disappoints on margins or provides cautious forward guidance, you'll see dividend stocks sell off precisely when you'd want to rotate into higher-yielding alternatives or dividend growth stocks with more structural tailwinds. In the next 9 minutes, I've shown you the exact SEC filing line item that reveals Costco's labor vulnerability, the BLS wage inflation data that makes it worse every quarter, the payout ratio threshold where dividend growth becomes constrained, the specific dollar impact on retirement income if a freeze occurs, and the earnings signal.